think Europe has some unique characteristics in terms of a very long history. I think it's quite unique cultural wise what we've been able to build here over the past couple hundred years in this. But yeah, something specific. I mean, it's a certain culture, I would say. I think that's quite. It's quite fascinating also to study the history of these kind of companies, and some of them have been around for over 200 years. And then you're thinking, well, what's happening here? That's giving the Lindy effect credence, if you will, like classic luxury companies or companies that have been around for 150 years. And then you see that when you read book about such a storied company, basically, then you see that the family actually helped a business to survive one or two crises, and now they're actually established brands and flourishing in their industries. That has, in large part, it had to do with the family that was a steward of the longer term view, instead of maybe, let's liquidate the company, let's get a big cash profit or a one-time benefit, and then we can invest it in something else. And so there's I would say, a certain permanence in European culture that makes it unique, and that maybe is a breeding ground for these kind of family business vehicles.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Michael Gielkens. He's a partner and co-founder of Tresor Capital, a Netherlands-based independent investment boutique specializing in actively managing wealth through family holding companies and serial acquirers, known for his deep expertise in capital allocation and his unique focus on businesses with strong owner-operator alignment and long-term value creation. Michael, how are you? So nice to see you again.
For the invitation, Bogumil. It's great to be here. I'm doing fine. How are you?
I'm doing great. I've been really looking forward to this conversation. You and I spoke on a few occasions, and we ran into each other in Omaha, picking up bags at the airport after a long late night flight, which is something that happens in Omaha. And I have a million questions for you, but I do want to bring up Omaha as an event, coming to the Berkshire meeting, and you and I were there. I don't know how many times you've been there, but I talked about this event on the show many times, how it's pretty special, and what Buffett and Munger were able to create as a phenomenon when we come to Omaha and we run into friends picking up bags in the middle of America and people that come from all over. It's pretty unique, and I'm sure it's going to come up in this conversation. I want to jump right in. I want to ask you about the early days, and you know it's coming. I want to ask you about childhood upbringing and how you think that time shaped you.
Ooh. Um, well, if we go back around 35 years, there was a small boy with a similar amount of hair that joined the world. So that hasn't changed. But uh, my upbringing was I've got two Dutch parents, born in the US but raised in the Netherlands, and yeah, my dad was always he was a financial director, so he was kind of in the business world, and my mom was more the, let's say, the emotional type. So I think that was a well balanced education and upbringing. They early on taught me right from wrong, if you will, and yeah, showed me the ropes in terms of be smart, save your money, don't spoil everything when you're spending it, and yeah, make sure that you know the value of a dollar. So I think that's very important to have a good financial upbringing as well, next to the moral founding that everyone needs, I think.
It's fascinating how much we learn in those early years. I hear those stories from people. And I think at the time, we don't appreciate how much it matters. And then, 30 years later, we're picking a stock, and you might be picking it because of what your grandma, grandpa, or your parents showed you in terms of how you think about money, right? And you feel like, no, I learned it in a book. Some of it you did, but I think a lot we learned just watching people in our lives. I do want to talk about that connection. Born in the US, living in Europe, and the Netherlands, the Dutch Republic, has a fascinating history in my mind. It's a place where the first securities were traded. It's the place where, big businesses with global reach were started. And a lot of those ideas came to New Amsterdam, which we call New York these days. And actually, downtown New York, you can go and see there's a statue that says it used to be New Amsterdam. And a lot of old Dutch families actually apparently own still some of the land under some of the buildings in Lower Manhattan. There's a connection between the two countries, undeniable. But do you think about it sometimes that it's the Netherlands that was the birthplace of a lot of ideas, structures, concepts, principles that are the framework for the work that we do, which is investing money for people and taking risks to chase business opportunities? It's the Netherlands.
Yeah, that's a fascinating history. I think they sold it. They sold New Amsterdam, now New York, for $24 at the time. But I don't think you get much more than a couple of cups of coffee for the same amount of money these days. So, but it's a very interesting history that both cultures are very entrepreneurial, have a lot of entrepreneurial footing, and yeah, I think it's fascinating that innovation in both countries is something of hundreds of years ago, but also something of these days. If you think of I think both the Netherlands and the US have, let's say, tech innovation at a high level with chip production or high tech companies. So whether you go back 50 or 100 years, or you're looking at those countries today, it's still there's still a lot of overlap. So that's quite interesting.
To me, it's the birthplace of the idea of a shareholder. The idea that somebody else will start a business. That person has an idea and they don't have enough capital, whether it's to take a fleet of ships across the ocean or go mine something in a new part of the world, or in these days build something in code and create software that will change our lives. But the idea of a shareholder, a minority shareholder, that has the right ownership and the right to the dividends, income, and everything else, and the assets behind it. To me, the Netherlands is the birthplace of this idea that even allowed for this conversation to happen, because a lot of things we're going to be talking about is basically what kind of businesses are worth owning. And as a shareholder, am I going to be treated the right way down the road, and the alignment that you talk about and you write about? I'm very curious, Michael, what's unique and different about your investment approach?
I think what's unique in the sense that we always invest when there is a certain amount of skin in the game. in the company. That's a very important thing. That's not common it's something that people see as a nice to have, but for us it's really a need to have. So a prerequisite. I think that's important. On the level of the portfolio managers at Tresor Capital, we ourselves also invest in the same opportunities that we buy for our clients. So we think that's a very normal thing to have skin in the game to that respect as well. I think that's distinguishing. We try to have a very good follow-up with our clients as well, and then try to find things that are out of the ordinary. So whether it is the family companies that we buy, which we are going to talk about, I think, later in the conversation, but also when we invest in a fund or when we have a real estate or a private equity opportunity, it's always how are the fund managers invested themselves. So at each level of the investment process, we try to find where the alignment of interest is and try to make that the core of the proposition. So really having a partnership approach, if you will.
It's fascinating how that works. Once you own something, you're a part of something, you treat it in a different way. Whether a 5-year-old that's told this is your bicycle, they look at it in a different way than a borrowed bicycle. And I think we can translate that to a shareholder culture and a CEO and management culture. And we see examples. We talked about Buffett briefly, but Berkshire gave us an example of a company that promotes the idea of the management buying shares and growing their ownership in the business, not necessarily being given stock-based compensation for nothing, just for sticking around, but actually putting up their own money to become shareholders in the business. I think it creates, as you mentioned, a whole different relationship with the business itself and some sort of, maybe not a guarantee, but comfort for the shareholder that if you do well, I do well, and if I do well, you do well. And I think it helps with that agency challenge here of a CEO that has no ownership in the business and it's just a talent for hire. It's a very different mindset. Which brings me to the idea that you touched on, the family holdings. I manage money for families, multi-generational family fortunes, and I see what kind of thinking happens when you start to imagine, 100-year vision, how you try to treat the family fortune or a business. And I'll ask you about serial acquirers. I'm equally fascinated. But tell me about family holdings. There are quite a few Dutch companies that I know of, and I don't want to mention names, that go back to the time when ships were traveling between the two continents, and they're holding companies now and they own other businesses. But there's a lot of heritage and understanding of family holding companies in Europe, maybe much more so than in the US. Can you tell us why that matters, why that's important?
Well, it's again that alignment that you what I think is the most important thing. It automatically creates a very different mindset in terms of running the business. So if you look at Wall Street, there's been a couple of papers, research that has been done, surveys that have asked CEOs and CFOs, what are you focusing on? So would you, for instance, postpone an investment that's crucial to the future of the business, but that would distort your ability to reach guidance, basically? And over 80% of those managers they mentioned that they would prefer to postpone the investment and make the guidance rather than do the investment, which they themselves see as necessary. And that's something that will not happen very quickly at a family business, where you're indeed looking at multi-generational wealth, and you're looking at it's basically you could say a listed family office. So you're buying shares on the market, and you're becoming a partner with this long-term oriented uh, uh, vehicle, basically, where quarterly guidance is often not even given. Quarterly calls are often, unless it's mandatory, not even given. You mentioned Berkshire. They report quarterly earnings because they have to, not because they think it's they think on an annual basis you get all the information you need, and we will report to you the important developments of the business, because they're building something that lasts decades versus trying to steer closer to the guidance, which might also have connection with their incentive structure. So that's often also very very different with a family-owned company than with a let's say a non-aligned management company.
So it's not just ownership, but it's family ownership. And it changes the dynamic because you feel like I sit down with families and I have those conversations and I realize how many decisions are made, not just for the benefit of those that are even at the table, but for those that are not even born. And just the idea of making a decision that will impact someone who is not even in the room. And you're thinking about 100 years. The quarterly results or the quarterly outcomes are completely irrelevant in that conversation. I mean, they're nice to have, nice to know. You want to know if how your inventory is turning. You have certain metrics you want to look at, of course, as a manager, but you're not shifting the entire direction of the business based on some quarterly earning, especially counted in pennies. You're thinking about big strokes and big decisions and big things you can do. And sometimes you make decisions that you will not see the results for a decade or 20 years or 30 years. It completely changes the mindset, and I find it fascinating. Tell me about some of the misconceptions that people have about family-controlled holding companies.
Well, there are a few. Many people think it's a very complex business, or a very hard to get into, and with some structures I can definitely agree, but they basically think, well, why should I buy a holding company when I can also buy a pure play company? But the thing is, I view it basically as an actively managed ETF, where you have the cost structure at the holding company level of maybe 10 or 20 basis points, but you get this long-term stewardship by a family. So a lot of people think, well, it's too complex, too hard to for instance, you can't get a takeover, right? If you have a controlling shareholder or a controlling family, then a breakup is out of the question. So I don't think Elliott Management, if I can name that name, would do an activist campaign on a holding company. I don't see it. I don't see it happening. They also have a lot of, let's say, harder to value assets. So private companies, or investments in private equity funds, real estate. I even know of some holding companies that have gold, physical gold in a safe. Good luck getting through that diverse portfolio. You have some companies that have 10 businesses, but some have like 3, 4, 500 businesses, and getting in the nooks and crannies of those very small businesses that are under the umbrella of the holding company, that's a hard thing to do. So you're also you're if you will, hiring management and hiring the family business to allocate that portion of your portfolio, to allocate the capital, and your trust is important there, and that's where the alignment gives you a better, I would say, it gives you a better feeling of we're in the same game here. So my loss is going to be your loss, or my gain is going to be your gain, just as you just mentioned. But it can also be seen as nepotism, for instance. Like, someone's named as a managing director or a chairman or something, just because he carries the family name, versus that he has the qualities to that he's earned it. That can be problematic. You could see, what I already mentioned, the fact that the family has a big ownership stake often results in a lower free float. So for some investors, that can also be an issue. So there can be a lot of reasons why you don't want to invest in family-owned businesses. So it's very important to let's say trust but verify. So if the alignment is there and if historical track record is there, then you still need to um, yeah, I would say get comfortable, because when we look at our metrics that we look for, automatically 80 to 90% of the universe just falls off and gets eliminated right away, because there isn't enough, let's say, insider ownership or something like that.
The skin in the game that you mentioned, we'll come back to it. I'm curious as I'm listening to you. Now, I was born in Poland. I went to schools around Europe. I even went to a school in Brussels, not far from you, where you are in Maastricht. And I came to America and I discovered a whole different world of thinking about money. And in a nutshell, I would say that the United States is great about creating wealth. And I think Europe has a lot of heritage around preserving wealth. And I got to work with families that in many ways are on both sides of the Atlantic. And I think they captured the best of the wisdom from both sides, the ones at least that persevered with their wealth. Is there something unique about Europe that those family holding companies exist? We don't see them as much in the US, and if we do see them, I immediately think of privately held companies, which you mentioned free float. I wanted to ask you about that. In many cases, we just can't participate as public shareholders. But is there something unique about Europe that those companies are around, have survived, persevered, and flourished?
Well, I mean, it's you could say to some extent there is a certain amount of survivorship bias in this as well. There might have been some companies that haven't made it, but I think Europe has some unique characteristics in terms of uh, a very long history. Every single country, even every single province, even within the Netherlands or Belgium. If you drive 15 minutes, then they might have a totally different dialect, have totally different uses or habits, if you will. Uh, so that automatically creates a bit of a local fellowship, and yeah, I think it's quite unique cultural wise what we've been able to build here over the past couple hundred years in this area. So but yeah, something specific. I mean, yeah, it's a certain culture, I would say. A Belgian guy has a very different view than someone from Poland, for instance, on family history, uh, that long-term heritage, these kind of things. I think that's quite it's quite fascinating also to study the history of these kind of companies, and some of them have been around for over 200 years. And then you're thinking, well, what's happening here? That's giving the Lindy effect credence, if you will, uh, like classic luxury companies or companies that have been around for 150 years, and then you see that when you read a book about such a storied company, basically, then you see that the family actually helped a business to survive one or two crises, and now they're actually established brands and flourishing in their industries, and that has in large part it had to do with the family that was a steward of the longer term view, instead of maybe, yeah, let's liquidate the company, let's get a big cash profit or a one-time benefit, and then we can invest it in something else. And so there's I would say a certain permanence in European culture that that makes it unique, and that maybe is a breeding ground for these kind of family business vehicles.
I have so many thoughts I have to cherry pick. But I'm thinking of the work that Eric Markowitz is doing. He was a guest on the show, and he's doing research now about companies that have lasted the longest. and he's writing about it. I'm sure people can look him up, Eric Markowitz, and you might be familiar with some of his work. I think you guys should talk, by the way. But he's finding those companies around the world, mostly obviously outside of the US, that have been around for hundreds of years, and how much we can learn from them. In the world where it feels like you can be right or wrong within minutes, or you have to be a success or a failure within, a week or two, to think in terms of building something that could last. And we learned that family ownership has helped those companies, as you mentioned, to get through some really tough times. You brought up Poland, so I'll say real quick, real briefly, something I brought up on this show. I think I got drawn to this idea of preserving wealth over many generations, also because of the place where I was born, where it was physically impossible to preserve wealth. 2 world wars, half a century of communism. If it wasn't burned, it was stolen or confiscated. So I've heard tales from my family that there was success at different points in time, but sometimes after 10 or 15 years, some new wind, historical wind, came through and took it all away. So I was thinking, especially as I left Poland and moved to the US or lived in Paris at some point, I realized there are places on earth but that people were able to build on top of something that the previous generation was able to build. And intellectually, on the education side, I think Poland has really persevered. But on the financial side, not really. The last 30 years are very different. But in the US or in Western Europe, there are families that have been able to preserve wealth and compound it over many centuries. I think it's a fascinating concept. And to me, the idea of not starting from zero, from scratch with every generation, it's something that's very important. Munger and Buffett mentioned many times how the last thing they would like is to be in square one all over again and save the first 100,000. I think there's a massive lesson there. I want to ask you about serial acquirers. That's the other big area of interest, and maybe familiar to this audience, maybe less so, but there are a couple of places around the globe, Europe as well, but not only, where there are companies that are superior capital allocators, and they find a way to grow through very thoughtful acquisitions. Can you talk about them?
Yeah, sure. Well, I think your audience, you've had Chris Meyer on for a
Yes.
couple of times. So I was at a conference earlier this year where he was a keynote speaker, and so it's always interesting to hear him speak. And I think he's actually um, uh, made the topic more popular throughout the years, because a lot of people didn't know about these business models. So especially if you're maybe that's a bit of a home field advantage in Europe, because in Europe, and especially I would say in Sweden, that's like a breeding ground for these kind of companies. And then buying companies, spinning off a division, they start buying other companies again. I think it's very interesting. It's a similar model, you could say, as a holding company. So um, you're centralizing at the top management level. The only thing you're doing is basically making sure that you're sharing best practices within the group, and that you're allocating capital to its best use. So whether that's from the top level or whether that's pushing it down in the organization, um, it's a bit different, you could say, than a holding company. I would say Berkshire Hathaway is the typical name, as we mentioned, Buffett and Munger, where it's really centralized. And what's interesting that a lot of these companies have been able to decentralize it. And what's very interesting is then that you can get, I think it's, Acri once mentioned that he has this vision of a three-legged stool. And so you have to have a good business and a good management. You have to have good returns on capital, and you have to have good reinvestment opportunities to keep earning those returns. So I think Buffett once mentioned that if they could just pour everything back into See's candies, that the capital, that the cash flow that it's spinning off, then they would have a wonderful business. But unfortunately, yeah, it's a business that doesn't require a lot of capital. And with a serial acquirer, I would say reinvesting the cash flow that's the business model. So that's the whole raison d'être for the company. So I think that's a very interesting function of these types of companies that you automatically have this reinvestment function. Often they pay a dividend, so let's say 20-30% payout ratio, maybe 40%, and then if you can reinvest the remainder of that into buying new companies and earning like 15, 20, 25% return, that's a very strong formula for compounding right there.
It's fascinating. You talk about the reinvestment. You have to have a decent underlying business that generates cash flows. And there's a moment, I think it's challenging for a lot of managements, where you might not have enough of a reinvestment opportunity within the existing business. See's Candy is a great example for the audience. A chocolate company out of California, somehow very successful in some places, but never really succeeded at going global. Although there's a handful of locations around the globe, but nothing like many other chocolate companies that conquered the globe. Unique to this brand. But anyways, at some point you have to do something with that cash flow. And the serial acquirer model allows you to go places. And I think it's very important what you mentioned, that it's decentralized, right? The lower levels are empowered to make choices and deploy money at. But I think we don't talk enough about the reinvestment of the capital as shareholders. And can you talk about that, why it's so important? You know, we're looking at the earnings growth, we're looking at the sales growth. Some people look at the dividend and the margins, but the reinvestment opportunity is key. And Munger told us that at the end of the day, over a long period of time, it's the return on capital. That's what you're going to get as the investment return. If the business cannot earn a decent return, you're bound not to have a decent return at the end of the day over a long period of time. How do you go about evaluating that and why it's so important in the equation?
That was actually the go-to quote I had in my head. So
yeah,
for the return on incremental invested capital, like if you want to have an optimal compounding journey, then you need to be able to reinvest at those same rates of capital, so or returns on capital. So I think it's also a function of having a company with a strong economic moat. That's very important. And so I've just lost your question there, Bogomil. If you don't mind repeating it.
Why the reinvestment returns are so important, and how do you evaluate that as an outsider, as a shareholder? You look at the business, and I want to hone in on the idea that you just mentioned, which is the incremental capital, right? So you can look at the historical data and you can show, 20% return on capital. But the new business opportunities might not be at the same rate. And very few people, and a handful of my guests, really pointed me in that direction, that you have to pay attention. The incremental business, is it as good as the original business?
Yeah, so that's I would say a function of tracking the growth. How much capital are they laying out? And with acquisitions, it's often quite easy because they have to report cash acquisitions in their cash flow statement. So oftentimes they report the actual numbers that they've paid for, maybe not per acquisition, but on an aggregate level. Mm-hmm. So I mean, how much cash flow are those companies spinning off after they've been acquired? And I would say it's always important to look at the return on invested capital. So the invested capital, including goodwill, if you're talking about serial acquirer, because goodwill is your bread and butter. Yeah, the ability to keep on investing, and that's the level where trust in management becomes crucial. Because at the end of the day, as an outsider, it's very hard to establish if the company is still buying high quality businesses, or if the quality of the businesses is deteriorating, and then potential future returns might also be deteriorating. So that's to some extent you're trusting the stewardship of the management, and that's why having this alignment of interests is so important, that you know that they will not throw out capital just to reinvest it. That if they are a shareholder themselves, if they are an entrepreneur that own shares of the company, then why would I make a bad investment? I would rather pay a special dividend, or let the cash pile grow until I find attractive opportunities again, which some companies have been doing and have been doing quite well over the years. And other companies have been able to reinvest over 100% of their cash flow and earn returns above 20% on that. So, which has even flabbergasted the managers themselves. So that's even management itself might not know how long the runway is of being able to reinvest at good rates of return. And that's why it's very important to have, let's say, you'd rather invest with someone that's curious than someone that thinks that they know it all. So yeah, some clues in terms of how management is thinking about these kind of things are very important, and that's why I'm a big fan of companies that publish letters to shareholders or have big annual meetings with long Q&A sessions, or where you can just go and talk to management or talk to the family or talk to other shareholders to get a bit of an understanding of how they look at these kind of things.
It's that moment where one thing is what is and the other one is what could be. And what you're describing is understanding how those folks think. How do you guys think? And maybe at that point, it's less important to see the actual numbers because we're trying to see the future here, right? We're looking at the past. Somebody reminded me, when you look at the financial statement, it's the past. And what we're trying to see is how the future looks like. And as I was listening to you, a good friend, Robert Karas, who was a guest on the show, who's based in Vienna, who just posted on LinkedIn a collection of his comments about Buffett's early letters. He just posted one of the last ones. He'll come back on the show to talk about those letters. I'm looking forward to this conversation. But the last letter, when Buffett was closing his partnership, mentions how he's going to distribute Berkshire Hathaway shares. Berkshire Hathaway's at the time a textile company. Nothing exciting, really. Decent balance sheet and a way to use cash, but basic towards the end of its glory, if that's the best way to describe it. It would have taken an incredible imagination to see what Buffett was about to do with Berkshire Hathaway, right? And obviously this is an extreme, historical, for the books and case studies for millions to study for many years to come. There are many situations, as you mentioned, that the management doesn't really know, but directionally they can be right, but they don't know what kind of benefit a certain pivot in the business will do for them in the long run. It's a fascinating pursuit as a shareholder to evaluate that from outside. I'm curious about a certain phenomenon. You're looking at high quality holdings from what I'm taking and from what we talked about. Why do you think that's better than hunting for deep value and distressed assets? And I'll tell you in a second why I want to know. But why do you think that's a better place to look for opportunities?
So you actually have this distinction within holdings as well. You have holding companies at a very small discount, and you have holding companies at a very large discount to, let's say, the breakup value or the sum of their parts. I don't know about all of them. I can't. But in general, you can say a company that's been able to generate shareholder wealth for decades, so literally 15 to 20% over 20, 30 years, you'd expect a smaller discount because they've proven themselves to be good stewards of capital. They've treated shareholders well. They have treated shareholders as partners. They have consistently been able to, if one of their companies has had a crisis, to help them through it, or maybe to buy another company with which could strengthen it, or be countercyclical, so buying assets in 2008 instead of being paralyzed or frozen or something like that. And companies that have been able to consistently do that, I would say, deservedly get a lower discount. So you could call that with let's say a non-holding company, you would say that's a high multiple on earnings or cash flow, because it's proven itself. The business model has proven itself. When you have a large discount, often there has been some form of mismanagement. And the reason I say that is there's a French holding company, which I will not name. But let's just say their holding company had the name of a subsidiary, and it was the name of the family. That company was, let's say, it doesn't exist anymore in its current form. And so the holding company, the family said, well, that's too bad. We don't have our name on the stock market anymore. That family has, outside of their core investment, I would say, has started investing in real estate. And then two of their biggest real estate investments went bankrupt, or let's say one of them, I don't know if it's still listed, but it dropped 99%. So that's as close to bankrupt as you can get, I think. And they've destroyed capital, and they've made a move. They said, we're going to rename the holding company to the family name. But to do that, then of course they are going to use our name. So the company should pay the family a license fee to use the name. That was a very clear indication why this company deserves to be trading at a 60% discount to its net asset value. And that's just something, aside from destroying a lot of value with bad investments, poor execution, and nepotism in terms of hiring, and that was like the how do you call it, the stroke that broke the camel's back.
Yes.
For not wanting to invest in that company. So is it cheap? Yes, it's cheap. But is this a family? Is this an entrepreneur that I would want to partner with, that I would want to give a piece of my capital to manage? I would rather have a company then that has a bit of a lower discount to its intrinsic value than and that's growing it at a good rate, versus a company that's stagnating and actually has destroyed capital. Just because it's cheap doesn't make it a it can get a lot cheaper still. So
We know.
you could very well have a value trap there. So you have to be very careful.
I wrote a piece that will be published by the time this episode airs, where I was playing with this idea how, there are things that are cheap, there are things that are value, and there are things worth paying for. And I think in life and in investing, we are invited on this journey. Not all of us have to join, and I don't know if it's the best way to go about it. I'm personally moving up or moving on that ladder to a different way of looking at things over time. I think the catch is that a lot of people got attracted to investing because it resonates with what got them the capital in the first place, which is, a fairly frugal lifestyle, right? Like spending less than you make. And eventually you have a little bit of money that you can invest. So what got you here is this kind of mindset that allows you to look for cheap stocks, which we see as eventually value, what you pay, what you get. And eventually some of us migrate to a whole different way of looking at things. And the mindset that allowed us to get there is not the mindset that will take us to the next level. And I don't want to talk all about Buffett, but Buffett is an example to me of somebody definitely very frugal and very careful about spending money, I think, to this day. And somebody that transitioned with Munger's blessing in many ways, but probably not only, to looking for a way to compound over long periods of time. And buying 50-cent dollars got him really, really far. But going from where he was to where he is today, and I don't say this that everybody has to become a billionaire. I don't think that's really necessary. But on your own journey, once you realize that there are things worth paying up for, you might be doing what Chris Mayer talks about and what he shared with me on this show, that sometimes you might want to pay $1 or $1.50 or maybe $2 for $100 bill. And it completely changes the mindset and the approach. So that's why I asked you. And I like your answer, especially in the context of showing an example of a company that's a family holding, but it's a terrible outcome, because both serial acquirers and family holdings can be terrible investments too. I think it's a great reminder that you have to look and be careful what you're actually buying. I want to ask you, since we talked about this, unsuccessful case study, about any failures or setbacks that you've had in your career that taught you an important lesson. What comes to mind?
Yeah, in terms of career, I mean, I would say just in general, I've paid the piper in terms of my own investment mistakes. So
Huh?
buying companies that you think, oh, it's so cheap that can't possibly get any cheaper, or I've done the work and it's a matter of time before the market recognizes the underlying value, and then Mr. Market can make you very humble at those times. So I just made all the say beginners mistakes. Thought tactical analysis could work. These kind of things, being arrogant enough that you can think that you can time the markets. So just in general, those are some mistakes I would say that yeah, every investor needs to learn, and rather learn it when you're young and still for that time in your life it seems like a lot of capital, but hopefully when you get a bit older, then you think, well, rather than making that mistake with a couple $100, then with a couple thousand or tens of thousands or more. So
Yes.
yeah, that's, I would say, just in general, a development that every investor makes. And then yeah, I would say, I mean, you have to do the work yourself. That's also something I would say. You can't borrow conviction, because when the stock drops, then all of a sudden, yeah, why do I own it? Yeah, XYZ has bought it, so that they know what they're doing. So I should look at that as well. Yeah, but if you don't do your own homework, then I think you're. I mean, uh, there's something to say for shameless cloning, but to a point, I would say. So um, yeah, if you can't say or write down on a piece of paper why you own a stock or why you own a company, I think that's something you should stop and think about. Then is that really a conviction idea, or is it something that you think fits well, or that's just in general? I would say not big. Yeah, don't expect any Munger or Buffett lessons from me, but I would say those are just some smaller things that people should look out for, and that I've certainly learned the hard way.
The sound of it, and it's very true. We all go through it, make mistakes. I'd love to learn from other people's mistakes, but unfortunately, some of them we have to make ourselves. It's just a human experience. I definitely spent too much time early on in my career on cheap stocks and too much attention and too much focus. And I realized that the real money can be made in stocks that don't require as much attention and as many things to line up for them to succeed, basically. And it brings me to another question that I have for you. You have a list of companies, I'm sure, that you would like to own. And as you said, you eliminate so many from your universe to begin with. I want to ask you about certain periods. And this year, it's going to be an evergreen episode, but this year, 2025, we had a market correction globally in the first half of the year that we all still remember. And you and I spoke around that time as well and saw each other around that time. And I got to speak with other people. But you specifically, I'm curious, how do you respond in those moments of market volatility and downturns? How do you think about the portfolio? What is it that you do when the market corrects? Sometimes for 2 weeks, sometimes for half a year. What do you do with the universe that you like to operate in?
Well, it's always very important to have done the work on the companies that you would like to own, of course, on the companies you own as well. So, especially, I would say there was a divergence between a couple of European companies that we owned and North American companies that we owned. So there was a bit of a bifurcation in the portfolio. And at some point, we were looking at companies that have compounded capital for over 15 or 20% for 20, 30 years. with great track records, with great skin in the game, and then you just see them drop 20-30%. And we're not thinking that these companies have all of a sudden changed their business model. Yes, there was an external threat, but on the other hand, I mean, these are companies that have been around in some cases for more than 100 years in one form or another. And so we were very much focused on the fundamentals. We always have our valuations ready, and we always on a regular basis check what each individual company how the discount to their intrinsic value is compared to, let's say, each other, but also to its own history, recent history. And then when you have a company that normally trades at around a 20% discount, and it's suddenly at a 45 or 50% discount, yeah, that's, to some extent you could say that's free money, right? I mean, these are brilliant companies, but due to an external shock, they are sold out. And then when you have other companies that are actually remaining stable or even increasing, or lowering their discount, if you will, or having multiple expansion, to put it another way, then it's a very easy decision to make, to just as long as you have done the work and you remain, I would say, insanely rational to to some extent, then you can let Mr. Market come to you in those instances, and make a switch in the portfolio that might even increase the quality of the overall portfolio, and increase the risk adjusted return potential.
You know, I notice how surprised people are when you pick any stock that you want to own. And then I ask people, can you look at the 52-week or 1-year price range of that stock? And I'm amazed how surprised people are that companies that they think that are in the headlines and on the covers of magazines, that they traded in a wide range, even in the last 12 months. Any company you name, with very few exceptions, has traded in quite a bit of a range. And this year is unique, but any other year, they do trade in a range. If you know what you want to own and you have the patience to buy it, you could find some things at a much better price than if you just went ahead and bought it today. That's been my lesson. The other one is to avoid extremely cheap stocks because they're trouble, but that's a whole different topic for another episode. Michael, I'm curious about some personal habits or routines that you credit for your success as an investor.
I would say I'm always trying to be very open and very transparent in terms of, let's say, ownership or position, or the views that I have. So we have a newsletter it's free. It's increased to, let's say, 20 to 30 pages, and a lot of people are saying, well, you're giving away your portfolio, or you're giving away your insights into the company. And I'm very much for building partnerships. So I've learned that if you close off your network, then I think it doesn't open a lot of doors for you. Well, if you are willing to collaborate with other people, if someone sends you an email and asks you, hey, what do you think about the developments of this group of businesses, or is this an industry that's worth looking at? You could say, well, yeah, I don't have time for that. I'm focused on building a business. I'm investing. I'm looking at companies. You could also say, well, maybe someone also has some interesting insights for you to learn from, and to build a sort of an investment community. And I've learned that by having, especially in Omaha, I would say, just being open-minded and having open conversations, uh, without an agenda or anything, just to want to learn from other people. I think that is something that you can get back in a very big way, and that's opened up opportunities for me personally, but also for us as a company, that I would say that have been very fruitful and worthwhile. And so that's definitely something that I think is very important. always trying to remain rational, sticking to fundamentals, sticking to being open to change your view, to expand your circle of competence, for instance, but also to know when something isn't up your alley, so to speak. So and just saying this is something we don't do, or this is something we don't have any superior knowledge on. What helps you be successful? I would say just being honest and transparent, and you get that paid back. You get that paid back in dividends, I would say.
I like
Plus,
the
relationships compound as well.
Very, very much so. And I know people. I know that work for companies where they basically can only talk to people within the company or the investment committee of 5-6 people, and I realize how limiting it is, because even in New York, I would run out, go to events and conferences, talk to other people, because I always assume that I might be wrong about something. Even if I think I have the facts, I might be looking at them in the wrong way. And to this day, I say that I just want to be the least wrong. People come to investing, they want to be right. I just say, I want to be the least wrong. And I want to participate in this open-ended, I call it the infinite game. I borrow from James Carr's. But at the end of the day, having people in your life, and Omaha, and this experience, and, there's ValueX and other groups that connect, and having people in your life opens your eyes to different ideas. And even when I show up to this podcast, I assume that I will be challenged on some assumptions that I've made over the last 20 years of investing. And I'm open to change. Tell me where I'm wrong. I even open some of the talks that I give now and then. I tell people, I'll share with you what I've learned, but I assume that I'm wrong about some of those things. Tell me how I'm wrong, and I'm open to a discussion. I want to see it as a two-way street. I'll learn something, they'll learn something. And even this podcast, I invite people to write to me, and I connect them with the guests if they're open to it, because I feel like it could be a two-way street. Tell us what we're missing here. Michael, I have one last question for you. We were talking about being a successful investor. Let's broaden the topic. How do you think about success? What's your definition of success? That's an easy one.
Well, no, it's I don't equate that to a financial topic. A lot of people seem to do that these days, but I'm not a proponent of that. I think success is measured in terms of the relationships that you have, in terms of the fulfillment you get in doing your job. I think this was a hobby long before I became an investor professionally, if you will. I don't know if there's such a thing as a distinction between private and professional, or amateur and professional investors. But it's just always being curious, and I think the best way to phrase it is Charlie Munger once said at one of the Berkshire meetings, you don't want to be like the motion picture executive from California who had a large showing at his funeral because everyone wanted to make sure that he was dead. You don't want that to be your legacy. So
No.
I would say success is measured in the true relationships that you have with people you care about, and doing what you love, and always trying to learn, always trying to improve, strive to be a better person, and then I think that to some extent it takes care of itself.
Somebody told me recently that she wants to benefit the most people in her lifetime. And I thought of it, it's such a beautiful way of looking at it, because, you and I, you said you share your newsletter with the public. I post my essays on Substack now, and this podcast, it's open to the public. But I get so much out of it, and I think I underestimated what an impact it can have on people's lives. And this summer, I read hundreds of emails from people that reached out to me. I think summer is a good time to hit send and finally send that draft that's been sitting in somebody's mailbox. And to realize that there are people on the other side of the globe that have been following this podcast for 3 years and it made a difference in how they think about their family money and choices they make, or that someone of the guests that came that made a difference in how they think about life. It's very powerful and very humbling to think that such a small thing had such a huge impact. So I look at it that way as you, and the funeral idea, who's going to show up and why? I think it's a good question to ask. Don't just look at the number, ask them why they showed up. Michael, this was such a joy. I'm so glad we did it, and fascinating perspective on a US-born, European-based investor that's focused on very unique businesses, but I think businesses that we can all learn from and go back to the principles that make investing work. And you're operating from the place that gave us the shareholder culture, the joint stock company, and the first securities traded. I love history, so I wanted to bring it up. Anyways, Michael, what a pleasure. Thank you so much for today.
Thank you for having me. It was a great conversation.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.